Ted, kicking things off with you, your take on what drives markets at this point, given that big sell-off yesterday and technology now rolling over. Do you want to come in here and buy tech, or do you think we're in the middle of a moderate to sustained sell-off here?
Well, Maria, I think mostly, it's news-induced. I think obviously those are the most owned stocks. And so when people get a little nervous about what's happening, in the government, et cetera, I think they go to those stocks, and that's where we are right now.
How are you allocating capital, Ted?
Well, we have three strategies, which is conservative income, and then we have an aggressive income, which is really designed to beat the bond market. But on the equity side, we're about 75% invested. We're carrying about a 25% cash position. Primarily because we don't have anything else to buy. If we did, we would use it, but we don't right now.
Interesting. Oil prices hitting a 7-year high. OPEC deciding to stick with a modest output increase rather than a larger one. These gains have some analysts expecting OPEC to significantly lift production. What's your take on the price of oil, Ted, and is there an investable idea around this?
Well, Maria, for the past year, we've had a big position in energy, and it's something we like a lot. We think that with the complexness of the energy concept, what's happened is you can't get to this green energy line in the time frame they're thinking. So I think we're going to have a rough time and actually come in behind Europe and look the same. I think we'll end up with much higher oil and gas prices next year. And I suspect that oil, I wouldn't be surprised to go over $80 this year. But I think you've got to, if you own natural gas and oil, and we like companies in both areas.
So does that slow down the economy in your view, Ted? I mean, if you've got oil prices moving higher, does that crimp an economic backdrop for the economy, the macro story, as we approach third quarter earnings?
Well, Maria, I think you're right on that. And if you combine that with the rise in rents and the rise in home prices and the rise in price per gallon of gas, all of a sudden you have people really under a crunch. And I don't think it shows up too much until next year. But I think 2022 will be the tell-all year. And that's when we'll run into trouble with it. And that's what we foresee from here.
I see. You've also got all of these supply shocks happening, right, as a result of COVID and companies' inability to get people back on the job, truck driver shortage. What about that supply shortage that we're talking about? Is that going to be an issue for third quarter earnings that we're going to be hearing from in about 2 weeks? What's your take on the third quarter earnings season?
Maria, I think the earnings are sort of in the bag for the third quarter. I think the problem will come as you go forward in the next 2 or 3 quarters. And the problem about, just-in-time inventories and that sort of thing over the last 10 years is you live by the sword and die by the sword. And when you get into that situation and all of a sudden things stack up, that'll show up. But we think that's going to come probably in a quarter or 2 out, not in this quarter.
I see. Ryan Payne, jump in.
Yeah. Ted, so everything points to, from what you're saying here, I hear inflation next year. To your point, rents are going to start to go up. You've got oil prices going higher, and that's going to definitely crimp profits. Are you looking to reallocate your portfolio? Because I realize tech has been the quote-unquote safe trade, but we remember when interest rates were up above 1.7% earlier this year, long-duration assets like tech and bonds didn't do so well. Are you looking to move out of tech, move out of bonds, and move into more cyclical stocks because of that inflationary pressure that's right around the corner?
Well, Ryan, we moved out of long bonds last year, actually last August or so in 2020. And so we've not been in that area so far. Right now, we've pared back some things already. That's why we're carrying about 25% cash. And then we have a fairly substantial lifting. We've got quite a bit of energy really right now. So we think between those 3 things I just mentioned that we'll be okay for 2022. But I think you got a point on what happens with tech next year.